Hi fellow traders, Marv Eisen here from Timeless Dollar Trading Academy. You know, I've been trading for over 20 years and I teach a trading course based on what I've learned. And recently, several years ago, I studied the George Taylor trading technique, the Taylor book method, that is sort of an enigma because most people don't understand it. Taylor wrote a book based on price movements or measurements of price movements of market prices from lows to highs, highs to lows, and up and down, back and forth, and average the averages over a series of days. And he found that trading can be quantified to give a prediction of where the trading prices are going to be in the next trading session. Pretty interesting, right? And the Taylor trading technique is used by virtually every professional trader because since the 1950s, when George Taylor developed it, it's been relatively accurate at predicting where markets are going to trade and helping traders be profitable. Okay, and so I calculate Taylor's numbers and I use the Taylor trading calculator that basically takes Taylor's numbers using only the open, high, low, and closing prices of the previous day. And here you see it. I keep my dates consecutive, and I use the left column to enter the dates Monday, Tuesday, Wednesday, Thursday, and Friday. And then Monday, Tuesday, Wednesday, and Thursday, and Friday. I omit weekends, I omit holidays, non-trading days. So I keep the accurate records of price movements for each consecutive trading day. And the only four numbers that I use based on what Taylor taught us is the open, high, low, and closing prices for the day. Simple. Open, high, low, and close. And from that, Taylor's calculations become a series of 12 calculations, and the calculations boil down to averages, and the average of averages comes down to two numbers, the support and resistance for the following day's trade. Now that's the Taylor trading technique. I use it religiously, and as I said, professional traders do as well, and very few people know how to calculate the Taylor's numbers. And the problem with it is that although it's so accurate, you say, why isn't it taught more universally? Well, the reason it isn't taught more universally is, well, I'll give you an example. Pick up George Taylor's book. It's called The Book Method, and you can get it on Amazon. If you can read past the first chapter, you're a better man than most people, because Taylor was as good as an analyst as he was a terrible writer. And not only was he a terrible writer, his writing is enigmatic. In other words, can't figure it out. The first chapter is great. The first chapter talks about how traders basically trick other traders into placing trades that's against their best interests, okay? And it's really interesting, the first chapter. And unfortunately, the rest of the book goes into how he developed his numbers. And the reason that it's called the book method is because he developed it using a little pad or a little book that he kept in his back pocket. And so we called it the book method. It wasn't any big deal when he developed it back in the 50s. And he used it. It became sort of well-known among trading cognoscenti. But because he never gives the formulas in the book, it leaves you guessing as to what the hell he's talking about in terms of what are the numbers. I mean, everything is a mathematical formula, right? The Taylor formulas are not complicated, but it's difficult to ferret out what these 12 calculations are based on the reading of his book. And so there are other books that extrapolate on it. George Angel is one, Sniper Trading, and other traders talk about it. Linda Raschel talks about it. I'm not sure how she pronounced her name. Linda Rashley, I'm not sure. But she's a well-known trader. She talks about Taylor as well. But again, she doesn't give the formulas. It gives the general concept of what it is. And so here are the formulas. I've developed them. It took me quite a long time to develop the formulas. They're not difficult, but they're easy to put together in a calculator because there are only 4 inputs, the previous open, high, low, and close, corresponding to the date. And the calculations, well, I have it here on an Excel chart. The calculations are all calculated out automatically. And the 2 most important calculations are the days high and low, or the support and resistance, for the following trading day, not the trading day that's just closed, but the following trading day. And that's the power of Taylor's trading technique. It gives a prediction of where the prices are likely to trade the following day. Okay, and so I put these the support and resistance numbers on my chart each day in a rectangle, all right? And I draw the rectangle out prior to the trading day, because Taylor calculator gives us the price action of where prices are likely to trade the following trading day. And so I have my chart with a series of Taylor rectangles, and there are some rules to trading the Taylor numbers, and I've spoken about them in many of my previous videos in terms of where to enter, where to exit. And together with Taylor, I use the previous day's close as one of the 6 trade setups. There are only 6 trade setups that I teach in my course: gap, support and resistance, trend, time and price, momentum, and candlestick. There are only 6 trade setups. And these trade setups are common patterns that have been repeated and repeated and repeated over time. And so these 6 trade setups are the only trade setups that need to be known. And because there are only 6, how difficult is it to learn 6 trade setups? It's not difficult at all, is it? But together with the 6 trade setups, you have to know something about timing. And the reality of the market is, as you can see I'll take just a random chart, and as you can see, the market goes down, the market goes up, it goes down, it goes up. It's volatile. And these pullbacks can basically take you out of a trade, or if you're not going to be taken out, your broker is going to take you out, because you're trading on margin, right? You're not trading your own money, you're trading on margin. And so you'll be taken out of the trade with a loss. And so you have to know timing, you have to know how to recognize market reversals, even within the Taylor trading zone. Now, the Taylor trading zone, the power of it is not just the intraday support and resistance, but where to get on, where to get off. And it's a big picture trading algorithm. When I say big picture, in this chart, there are 10 points between each horizontal line on this chart. And so here we have from 68.75 to 68.24, about 50 points between here. It's a big picture trading chart, all right? If you can trade Taylor, now you can pick up a lot of points. You can make thousands of dollars in trading. And if you learn the finesse of how to trade using the trade setups to spot reversals, you can close your trade before markets reverse and you're taken out at a loss, and likely giving back all the profits you've made over the previous trade. And so, as you can see, my trading with Taylor comes down to my placing a rectangle on my chart each day. Okay, so I was going over a number of YouTube videos, and I look at what other trading instructors or trading informants or trading content creators post on their YouTube videos, as I do. And I came across one that was very interesting. And the fellow was talking about the box technique. And I never heard of it, the box technique. But I was interested, so I watched his video. And it was pretty interesting of what he was talking about. And I'm going to explain it to you. I'm going to go over what he said, what it was. And what he did was, he said, if you go to a daily chart, now this is a 3-minute chart, but I'm going to go to a daily chart of the S&P E-mini. Okay, so here's a daily chart of the S&P E-mini. And this guy was talking about the box technique. I was very interested. And so what he said was, you go to a daily chart of your market, whatever market you're trading, and you draw a box around, you take the day that's recently closed, and you draw a box from the high to the low. And we draw a box, including the shadow. So here I'm going to take trading on Monday, November 10th. I'm going to draw a box from the high to the low. Okay, that's about right. And then he said, expand the box to a minute chart, 5 minutes. He used a 5-minute time frame. I'll use the 5-minute time frame as well. All right, so I'm going to go back to the 5-minute time frame. Okay. And what he said was, in looking at the box, the most resistance was at the top of the box, right over here, the most resistance. And the greatest support was at the bottom of the box. And so when prices reach toward the top of the box, you trade to the downside. And when prices are toward the bottom of the box, you trade toward the upside. Well, that sort of makes sense, because if we're looking at one particular day, we're basically talking about support and resistance over one known day. And then he said, well, if we extend the box, we can trade successfully by extending the box and buy at the bottom, sell at the top. Sort of makes sense, sort of similar to Taylor. Okay, and I'm going to take this forward and let the prices run. Now this is Monday, November 10th. Okay, prices are trading toward the top of the box. So according to the box technique, you sell the market. All right. Now just for illustration, there are 25 points between each horizontal line on this chart. Okay, let me stop that here. Let that sink in. On this chart, there are 25 points between each horizontal line. So there are $1,250 between each horizontal line on this chart. Let's continue. Okay, we're on Tuesday now, November 11th. No, that we're after hours here. So here, we're in the day session. And again, what he said was, when prices trade at the top of the box, it's the area of most resistance. And at the bottom of the box, area of most support, greatest support, okay? I'm going to extend the box, and we're Tuesday, November 11th. Okay, so here the prices are moving up out of the box, and according to his box theory, when prices are toward the top of the box, we sell the market short. So by selling the market short, let me expand this chart somewhat so you can see what we're talking about. Now here, we're 10 points between each horizontal line. So if you were to, well, this is the overnight session, so let's go into another regular trading session. If you were to sell the market short, based on this box theory from a previous day's candle, you'd pretty much be blowing up your account. And so where's the guidance? I mean, it's one rectangle based on support and resistance from one particular day. And so the box theory, it's interesting. I admit it's interesting, because if you take one particular day and you draw a rectangle around the high and the low point, and you extrapolate it out toward the minute candle, and you can say, well, the support is down at the bottom, the resistance is up at the top. Makes sense, right? Support and resistance is one basic trade. Everyone knows the support and resistance. You look for support, you look for resistance, and trade the area in between. Okay, so the box theory, it's okay on its face, and I'm not knocking it. But as you can see, if you trade the box theory, there's something here, but it's got to be refined. So I'm going to go back to the Taylor trading technique and prove to you that the Taylor trading technique, basically the box theory, tries to replicate the Taylor trading technique without the mathematical underpinnings that give it accuracy. Okay, so as you can see, here's a day where the box is below the calculated trading technique. All right, Taylor trading technique has been proven reliable for most trading days for over 80 years. All right, I'm going to delete this box. I'm going to go back to the Taylor trading technique. I'm going to talk about some of the things that guy said about the box theory again, and I congratulate him. I think he did a good job, but there's more to the box theory, because if you look at the Taylor trading technique, it's really a box, but it's a box based on knowledge. It's a box based on the measurements of price movements over a period of time. Now, in addition to the Taylor trading technique, and I want to point out again what this guy said, and it should be obvious to anyone, that if you take a measurement and you try to quantify the market or a candle on any particular day, the top of the candle is resistance, the bottom of the candle is support, and that's where the buying is and that's where the selling is. Basic, all right? But the box is not, and whether it's a box that's artificially created based on a particular candle, or it's the Taylor trading measurement, the Taylor trading zone, it's got to be used with some skill and judgment. And so the key to using the Taylor trading zone and the box theory, and this is where the box theory needs some tweaking. And again, I'm not taking anything away from it. You've got to know where to get on. You've got to know where to get off. And the keys to knowing that are the intraday high or low within the first half hour to hour of the day. On most days, the market will try to trick you into placing a trade that's going to be a loser. And so at a certain point, the market must tip its hand. In the early part of the day, we know absolutely nothing about where the market is going to go. Remember, nobody knows where the market's going to go on any particular day. So what I suggest, put the trading zone on your chart, wait for the half an hour to an hour of the day, see where the intraday high or low is. All right, this is a 5-minute candle. I'm going to go to a 3-minute candle. I happen to like a 3-minute candle. All right, this is Thursday, November 13th. The trading zone is support at 68.77, resistance at 69.24. Okay, and the market opens, faded the trading zone, in other words, moved away from it, and put in a low right here at 68.16. Now remember, I said within the first half hour to hour of the day, find where the intraday high or low is. Why do I say that? Because when those 2 points are established, by 10 o'clock, or 10:30 I should say, the hour after the opening bell, the market will take out one of those intraday levels. It'll either take out the intraday high or take out the intraday low. And based on the one that it takes out, that's the direction that the market is most likely to trade for the rest of the day. And so where is the market going to go? Well, that's where we have to place our trade. And so we're going to place our trade after the market opens, all right? Because we don't know where the market's going to go. Here the market immediately plunged on the open and then put in a low here at 68.16, started to climb up. Let's see where the market went for the rest of the day. Took out the low right here at 10:40, about 10:30. Yeah, 10:33. Took out the previous low that was put in at 9:45. And so where was the market going to go for that rest of the day? Okay, so over here, where the market took out the low, we can assume with a good deal of certainty, and nothing is certain in the market, but we can assume with a good deal of certainty that prices are going to trade down for the day, right? And so now we have some more information that we didn't have when the market opened up. So what we're going to do is to take our tailored trading zone. Let me bring my chart a little smaller so that you can see what I'm going to do. And I'm going to transpose the trading zone to the intraday high or low. In this case, I'm going to transpose it to the intraday high because the tailored trading zone range, I'm going to clone this. The tailored trading zone range is particularly accurate on most days. So here was the range. So, having taken out the 945 price, right around over here at 68.19, we can take a pretty good assumption that the market is going to trade down to the trading zone through the trading zone range. And remember, the range was a stat. We moved the range down from where it was calculated to the intraday, in this case, the intraday high. And we're going to get off our trade around 68.03, 68.02, somewhere around there. And if we take our trade at 68.20, it's an 18-point trade with a high degree of assurance that we're going to be successful, all right? And that would have been our trade, right about from here down to here. And that's it. Now, the trading range, prices beyond that, we don't really care. Why tempt fate? Market is risky. If we have an assurance of making 18 or 20 points, somewhere around that, on a particular day, based on knowledge of the intraday high or low, knowledge of when to wait, when to jump on the trade, which direction to jump on the trade, we can have a pretty good sense of being profitable if we adopt this strategy on each day that we trade. Now, every day is different. Let's see where the market went for the rest of the day. I don't particularly care because, for example, we want to trade within the trading zone. If the market trades outside the trading zone, for whatever reason, could be an external factor, could be the Federal Reserve comes out with an announcement, Donald Trump comes out with an announcement, we don't know. So on this particular day, prices actually plunged, and there was no way to really know it. But we want to use, again, with respect to the box theory, we want to trade within a box where we can take it that the greatest point of resistance is at the top of the box, the greatest point of support is at the bottom of the box. On this particular day, prices traded beyond the trading zone, fell down below it. And so on most days, it's going to trade within the trading zone. I'm going to get rid of this. I'm going to show you what I'm talking about. And so you'll notice I also draw a horizontal line to indicate where the previous day's close was. And because the gap trade, where prices open above or below the previous day's close, it's a pretty good trade. It closes about 75% of the time. Again, don't bet the farm on it, but for the most days, the gap trade is an excellent trade. If you trade nothing but the gap trade, remember, 6 trade setups, GST, TMC, gap, support and resistance, time and price, trend, momentum, and candlestick. And so these are the 6 trade setups I teach in my course, plus the tailored trading zone. Here's another day where prices traded outside the trading zone. But if we clone our trading zone and move it to the intraday low or high, we can see with a pretty good deal of assurance that prices are going to trade through most, if not all, of the trading zone. All right? Now, I spoke a little about being reversed out of the market. Now, markets tend to reverse all the time, and there are many a trader who has made money in the market only to give it back when the market reverses. And so one of the key elements in trading is to use an indicator that will confirm a market reversal. And that indicator, the one I use, you see down here at the bottom of my chart, is the stochastic. And the stochastic is an oscillator. In other words, it moves up and down between 2 limits. And it indicates where prices are likely to reverse. It's a confirmation of prices reversing. Actually, you really have to look at price action and correlate them to the stochastics to see where prices are going to reverse. And you have to use a lot of patience. And if there's one word that should be imprinted upon every trader, it's the word patience. Because there are only a couple of good trades in any particular week. And so one of the trade setups, and I've mentioned it twice so far in this video, is candlestick. What's the candlestick trade? The candlestick trade is typically a hammer. For argument's sake, for a very simple example, and there's one right here on this chart, it's where a hammer forms at the bottom of a price decline that would indicate a reversal. And a hammer is a very particular type of candlestick. It's a candlestick with a very small real body and a shadow at least 3 times the length of that real body. And here is one right over here on this chart. You see this hammer comes at the bottom of a decline. There are 5 points between each horizontal line on this chart. 5 points. So this is a decline, 5, 10, 15 points. 20 points decline, and then the market came back up. And notice something else. The hammer itself is a pretty good indication based on the fact that it is coming at the bottom of a previous decline. It's a pretty good indication of a market reversal, but we want to have some more assurance that the market is actually going to reverse, and that is an oversold stochastic. And as we can see, stochastics are oversold right at the point of that hammer. And so we can take a trade, if we have the patience to wait for that hammer, we can take a trade to the upside and ride the market up for the day. Candlestick trade, beautiful trade, all right? Takes the guesswork out of trading when you know what to look for, but you have to have a lot of patience in knowing what to look for. Can also look for something else. What else is here to look for? Well, how about resistance, support and resistance, okay? Let me draw a horizontal line here. Okay, do we see support? Even with the candlestick, this is a support. We don't see a hammer over here. Here's our hammer. But between the hammer, the oversold stochastic, and the support being put in prior to that hammer that was printed at 11:30, pretty good indication that we could take a trade to the upside. So you have to know what to look for. And where do we get off on the upside? At the top of the Taylor trading zone. And so if you know what to look for, you can limit your trades to the very best ones and just never mind getting on trades for the hell of it, which is what most traders do. Looks good, price is going to go up, they're going down, prices go up, they go down. But if you have the patience to wait for the best trade setups and know what to look for, and use an indicator, a confirming indicator like stochastics. Remember, indicators can only confirm. Prices are the real thing that drives all indicators. But the price history, which is the basis of support and resistance, in this case we see support, together with this hammer being put in, we could take a trade to the upside and make 5 points between each horizontal line, 5, 10, 15, 20, 25, 30, 35, 40 is $2,000 on one contract if you have the patience and know what to look for. And so I'm going to go back to that box theory again. And again, it's a good attempt at trying to simplify the Taylor trading zone. But to use the box theory without knowing the underpinnings of it, which I've got to assume is the Taylor trading zone, because the box is a zone, right? The Taylor calculator, the Taylor trading zone is a zone. It's an area where prices are likely to trade for the following day. And so we can transpose it. The trading zone range is pretty accurate. The absolute support and resistance, less accurate, especially in markets that we're experiencing these days with what's going on in international finance, domestic finance. And so the markets are, in my opinion, being artificially supported, but that's neither here nor there. If prices are going up, they're going up. We're trading, we're not investing. And so knowing what to look for, and the basis of the box theory, again, is you draw a box and resistance is at the top. We don't place a buy order at the top. We don't place a sell order at the bottom. And that's the essence of the box theory. But there's no mathematics behind the box theory. It's just a box based on the resistance and support or the price range of a particular 1 day's candle. And so if you learn to trade using the box theory, you might make some money. Not saying it's not good, but if you really want to trade zones, trading zones, you need the Taylor Trading Calculator. You can read Taylor's book, The Book Method. Try to read it. It's a fascinating book, at least the first chapter. Most people can't understand past the first. But maybe you might be one of the few who has the patience to really grab it, go through it. Otherwise, you can get the Taylor Trading Calculator at my site at timelessdollar.com. Calculator looks like this. It's easy to set up, easy to maintain. You just have to enter 4 numbers each day. Everything to the right of these first 5 columns is calculated automatically. And here from Tuesday, December 9th, resistance, and I'm going to give you the numbers, 68.86 resistance, 68.38 support. And the range is going to be 47 points, all right? And that's based on the average of averages of highs and lows of the previous 5 days trading. And that's how I put my numbers together, and that's how others put their numbers together who know the Taylor Trading Zone. But you also have to know how to apply it. You can't just trade blindly, put a box on your chart and say, oh, this is support, this is resistance, buy support, sell resistance. You do that, you're going to blow up your account, I guarantee you. So thanks so much for watching. Again, kudos to the guy who came up with this box theory. Have nothing bad to say about it. But if you really want to be a good trader, trade based on what you're knowing, what makes sense, and what is mathematically based on mathematical numbers from the most recent previous days price action, use the Taylor calculator. Again, thanks so much for watching. Trade safely, use lots of patience, use lots of patience, use lots of patience, and I'll see you in my next video. Marv Eisen for Timeless Dollar Trading Academy.